Hi, I'm Andrew Berman for the Mortgage News Network, and we're here in San Diego at the Mortgage Bankers Association of America's annual convention. Joining me today is the President and CEO of the Mortgage Bankers Association of America, David Stevens. Thank you very much for joining us, David.
Sure, good to be here.
So listen, we were talking a little bit before. I want to just kind of continue our conversation. And listen, it's October. TRID implementation just happened. We can't actually have a conversation with you and not ask you what you feel the impact of TRID was on production. Well, there's been a lot of nightmare scenarios, but overall, do you think that there's been a significant impact on production, and where do you see the production being at for the industry in 2015?
Sure. Let's start with TRID, and then we can talk about production. And keep in mind, we are heading into the winter cycle. So typically we would see a trend down of mortgage applications anyway, unless there was some rate rally and everybody suddenly refied. So, the week before October 3rd, we saw applications increase 25% from the previous week. So what happened is a lot of loan officers front-loaded, got on the previous rule and got the disclosures done and out before the TRID implementation. Following week, after October 3rd, we saw loan applications drop 27%. So I view that kind of as a net wash. It was a swing forward, and then that paid through to the following week. We'll see what happens in these subsequent weeks, whether there's a real impact. I traveled around the country the week of TRID. I was in Colorado visiting multiple independent mortgage banking firms. They all had different systems. Some had no hiccups at all, business as usual. I was just talking to the CEO of Quicken Loans. He's already closed loans on the TRID rule through their system. Others, and I won't name the vendors, but we all know there were some vendors that actually had to do software updates that Monday, the 5th of October. One of them did 2 updates during the day, and we found mortgage originators that couldn't board loans on the system because they weren't ready or they had to do redisclosures. And the good news is, I think what we all know is it's more about what happens at the closing disclosure time, because right now, even if you make a mistake, you can redisclose. You've got plenty of time. And so, short answer, interpretation, I don't think it's really going to have a huge impact. I think some vendors were not as ready as others, and that made the lenders not ready. But generally speaking, I think we all got ourselves ready as an industry. Best we could, anyway.
Great. I agree.
Yeah.
TRID overall, do you think this is a good thing for the borrowers?
The old RESPA forms, as we all know, between the good faith estimate and the TILA disclosures, the Reg Z form, as we all knew, they never matched up anyway. And so we always had to explain to borrowers, don't worry about that APR. We do those kinds of things. I'm not saying we do that today, but I was a loan rep a long time ago. But the good news is I think the forms are better. They're more readable. I'm not sure they were as needed necessarily. What the problem we were trying to solve was sort of eliminated when we all ended up just doing full doc 30-year fixed rate mortgages to almost everybody. So I don't think a consumer needed more explanation about my 3.5% rate and my closing costs. It was getting pretty easy. But for the future, I think the forms are probably helpful. I just worry it created another disruption. It was a whole lot of work. And as everybody knows in our business, all the time you spend doing what we call change management, getting operationally ready for any role, is time away from thinking about new ideas for customer service, new innovations that you might do to wow your customers, because you're focused internally on getting your operations and your controls in place. That sucks all the resources out of your companies. So I'm not saying we shouldn't have done it. I don't want to be taken as just a knee-jerk, anti-regulatory guy. I think there are some good rules that are out there. I think this one, over the long run, will be a better set of documents than the old documents. Whether the timelines are right, we'll determine that. If there are exploding loans at the closing table that have a domino effect, a lot of other loans aren't closing as well. We got to see what happens. We're going to track that data closely. We have a very close relationship with Rich Cordray. He was obviously just here speaking. He likes the information we provide him, so we'll keep a close watch on it. Not going to cry fire in a crowded theater. I think it's more important we just monitor what happens and see what the real impacts are.
Great. So listen, I got to ask you. You as former head of FHFA, as also someone you've talked a lot about Fannie Mae and Freddie Mac and FHFA's role right now and what it's going to look like in the future. So if you were in charge of the FHFA today and you can decide the future of the Fannie and Freddie, what would you do to shape their future so we can continue to grow, or I should say foster the growth of home ownership and the American dream in the United States?
So that's a question with a 2-hour answer. So, let me just say this, and you're going to hear, there's some speeches here. Mel Watt, who heads FHFA, was speaking about the future of the GSEs. Antonio Weiss from the Treasury Department published an op-ed in Bloomberg this morning of this day, talking about that they are not going to unwind Fannie and Freddie from conservatorship. And Michael Stegman, who works for the president on the National Economic Council, will speak here in an hour or so and say the exact same thing. So the challenge is we desperately need the role that Fannie Mae and Freddie Mac provides in allowing us to lock in a 30-year fixed-rate mortgage and deliver it into an MBS that gets sold into the capital markets, that has a guarantee on that security so that investors will buy it. I mean, that's what we call the flow business that the GSEs do. So we need to make sure that continues, but we got to answer all the critics. We got to answer conservatives that say the government shouldn't be guaranteeing or being on the bleeding edge of risk. So this idea about risk sharing that's going on,
Right.
That's a way to de-risk the taxpayer, but keep the guarantee, the full wrap on the mortgage-backed security. It's something that we're working with. Mel just spoke about it at length. Mel Watt just spoke about it at length from the podium. And we've got to deal with things that the liberal community is concerned about making sure that we have commitments to sustainable, affordable housing goals from the GSEs. But we've also got to make sure that we protect against the things that both Democrats and Republicans talk to me about all the time, and I'm on the Hill constantly, making sure the portfolios are never used as hedge funds again like they were before when they bought the AAAs of subprime loans or bought Alt-A product on their balance sheet, making sure there isn't, I think we have to be careful to make sure we don't go back to the old days when the biggest institutions got sweetheart deals, special G-fee discounts, and I don't know if everybody remembers the history, but Countrywide had Fast and Easy as an exclusive contract deal. I ran, and nobody else could have it in the early years. It was just to the biggest lender. I was running the single-family business at Freddie Mac. We gave similar credit waivers to our largest customers. And my first meeting when I came to MBA was to meet with, at the time, Ed DeMarco, and demand that they level guarantee fees and make it an even playing field for everybody. We've got pretty much that today, where independent mortgage bankers can compete almost equally with, the biggest bank in the country. We can't let that slip back. And so there's things that I think, you can end up in a future state where Freddie Mac and Fannie Mae are doing what I just described we need them to do, but they don't have the liberty to ultimately put us back to where we once were, where you give deals for market share or volume size or the kinds of things that ultimately made it impossible for, really good companies to compete on a level playing field. I think that's where we ultimately need to align everybody on that same outcome.
Great. That's great. Great. So, David, I don't want to switch subjects, but I think this is something that the MBA has been on the forefront of bringing young people into the business. So the average loan officer is right now, I believe, 54 years old.
Yeah.
What are the things that we as mortgage companies can do to attract more of the millennials into this business to show them how great this industry is?
Yeah, so the first thing is making the career sound exciting. A lot of people, I have a son who's in his mid-20s, and I'm hoping he'll get into the business. But he didn't want to at first because everybody just watched headlines for the last 7-8 years about what's going on in housing. We've got to put that in the rearview mirror. I mean, the next decade is going to be extraordinary. We're going to have anywhere from 14 million to 16 million new households formed in this country. Just to put in comparison, for the last 4 years, we've been averaging about 600,000 households formed per year. The next decade, we're going to average 1.1 to 1.2 million households. It's literally going to explode. You're feeling it already. There's just not enough inventory in the markets today. Forget whether the millennials are ultimately going to start buying. They're going to start buying. They want to own homes. They may be delaying their decision. It's going to be really exciting. It reminds me of when I first got in the business 30 years ago as a loan rep, and I financed the baby boom generation for my whole career. This generation's bigger. They're just starting to come out of the woodwork. Demand's going to be extraordinary. Every economist knows it. They're all saying the same thing. So it's an exciting career. But how do you bring them in? We spent the last decade hiring each other's loan reps. We started doing it on product, then we did it on comp plans. Who knows what the recruiting strategies are? We've got to get a younger generation in. So we've developed a program called Mortgage Banking Bound. And it's an introductory program. We have a lot of companies who are offering it, and they're recruiting from veterans. They're recruiting people from other industries. I can name an independent mortgage banking firm I went to visit just recently in Boston, just south of Boston, who developed their own program. They hire in aggressively from ex-military vets who are looking for careers. They go to their career fairs. They recruit them. They pay them while they train. They have to pass a test. They actually had a fail-out rate of about 30%, but everybody who ultimately made it through the class was hired on the job. They were diverse, African-American women, Hispanic men, you name it, across the board, and it was training and developing them and providing them careers. That can be expensive, right? Yeah. So, our Mortgage Banking Bound program is cheap. It's scalable. We even offer scholarships for diversity hires that companies can take advantage of. So, if you remember the MBA, and this is interesting to you, I just say, reach out to me. I'm Dave at MBA.org. Trust me, anybody can email me. I always respond, and I'll get you in touch with the right people. But there's no doubt. I'm 59 years old, and I started as a loan rep in my early 20s. I always look at Greg Frost because he and I bump into him every now and then around the country. But I remember him when he was that killer, hot-performing young loan rep a couple decades ago. We're all getting older.
He still is.
Yeah, I know. But we've got to recruit in, the next generation, and it's got to be more diverse. I mean, if we don't figure the diversity issue out, this isn't make believe. 70% of all existing housing stock owned in the country today is owned by white non-Hispanics. For the next decade, 2/3 of all new household stock is going to be owned by minorities. It's just a fact. It's demographic reality. Not making any social justice play here. I'm just saying that's where the money's going to be, and it's a business opportunity. So there are educational programs you can leverage to do recruiting. I really encourage people to try to tap into. If you can't pay them, try to get internships for the summer, where students will come and work cheaper or work on a team or however you can set it up. But I think there's a huge opportunity ahead, and we ought to be excited about it. We're going to need to grow.
So, do you feel that the independent mortgage companies are best positioned to handle those, the minority homeowners, the young minority homeowners that's really going to be the fuel for the next 10 years?
Look, right now, I think the independent mortgage banker is sitting at the absolute perfect sweet spot. Let me just tell you why. FHA is the entry program to home ownership. A lot of the larger financial institutions are publicly backing away from the program because of False Claims Act issues, and all they can see is what happened in their rearview mirror. Billions of dollars of penalties have been paid. They have the higher overlays in place, et cetera. I'm not saying they're making the right or wrong decision. That's not the point. The point is just in terms of business opportunity. Independent mortgage bankers are filling the void of the FHA program. That is the number one entry point for first-time home buyers. So let's just start there at ground zero. They're clearly Fannie and Freddie play a role there as well. But yeah, they're uniquely positioned to play the role. And the other thing I would just highlight, even though the market's going to be a little smaller next year than it was this year. We had $1.4 trillion roughly is where we'll end up this year. Next year will probably be about $100 billion less. But that's just because of refis going down. Purchases are going to keep going up, purchase activity. The independent mortgage bankers just have dominated the purchase market over the last several years because a lot of the larger institutions were focused on HARP refinancing on their balance sheets and a variety of other things. Some of the bigger guys had call centers and they were just doing a lot of refinancing. And so the independent mortgage bankers took up a lot of the purchase market. They have the relationships at the point of sale and across the board, but at a general trend, the data is very clear. We aggregate all of that. The last thing I'll just say is, when I was a loan rep, you had a lot of new entrants coming in and competing with new business models, mostly no-doc models. A lot of new no-doc origination groups. They would offer products that my company wouldn't have, for example. I'd lose my people, and I had a lot more competition. There's really less competition today. If you think about it, the independents and the large banks and the regional banks, community banks, credit unions, but you don't have all the fly-by-nighters. And so even at a $1.3 trillion market or whatever it's going to end up being next year, a lot of opportunity and business for the independent mortgage bankers to take advantage of, which is most of your audience, I assume. So huge opportunity there.
David, thank you so much. I really appreciate I know you have a very busy schedule, so it means a lot to take the time out of your day to spend with us.
Yeah, absolutely. Anytime.
I'm Andrew Berman from the Mortgage News Network. Stay classy, San Diego.
This is Mortgage News Network.